You earn your paycheck, cover your bills, and leave the surplus in a savings account. It feels like the responsible choice, yet that money remains stagnant while the world around it gets more expensive. Standing still in your financial life is an illusion. While your balance stays the same, external economic forces ensure you are actually losing ground, consistently above savings interest rates for several years, meaning a safe bank account guarantees your wealth will erode. Waiting for the perfect moment to invest effectively locks in this loss. The most expensive decision you can make is continuing to do nothing. Beginners often wait to invest because they believe they need a significant amount of capital or professional expertise to get started. In 2026, those barriers have been removed. SEBI has simplified mutual fund regulations specifically for retail investors, making the process more transparent than it was even a few years ago. You can now set up a systematic investment plan directly from your phone on apps like Grow or Zeroda with as little as 100 rupees per month. The objective is to pair specific financial instruments with your different life timelines, whether you are saving for a house in 3 years or retirement in 30. The first hurdle is simply moving past the inertia of your current banking habits and beginning the habit of monthly contributions. We evaluate every option based on 2 factors: how quickly you can access your cash and its potential for growth. Fixed deposits and recurring deposits sit in this corner of the chart. They are ideal for perking 3 to 6 months of living expenses. These provide absolute principal protection and returns between 6.5% to 8%. You can break the deposit and have cash in hand the same day an emergency occurs. However, after you pay taxes on the interest, these returns struggle to stay ahead of inflation. They provide stability, but they do not grow your wealth over time. View your FDs as an insurance policy for your daily life. They serve as a safety net, allowing you to take calculated risks elsewhere. For young professionals, the immediate goal is often maximizing the 1.5 lakh rupee Section 80C deduction to reduce their tax bill. The Public Provident Fund is a government-backed option with a 7.1% interest rate. Budget 2026 even increased the annual investment limit to 2 lakh rupees, maintaining its status as a fully tax-free haven. The trade-off is a 15-year lock-in period. Your capital is essentially inaccessible for over a decade, which enforces discipline but removes flexibility. An ELSS, or Equity-Linked Savings Scheme, offers a different path by putting your tax-saving money into the stock market via a monthly SIP. ELSS has the shortest lock-in period of all ADC options at only 3 years. It also offers the potential for 10 to 14. By automating your contributions, your investment grows steadily over decades, regardless of short-term market headlines. This approach removes the risk of a fund manager making a poor decision. Over the last 20 years, the Nifty 50 has delivered roughly 12% annual growth. The requirement is discipline. Index funds offer no protection during a market crash, so you must be willing to continue your monthly SIP when prices are falling. For long-term wealth, the consistency of an automated system is more effective than attempting to time the market's highs and lows. Selecting a single best account is less effective than assigning your money to specific jobs based on your needs. Here is a practical allocation for a 5,000 rupee monthly budget that addresses safety, taxes, and growth simultaneously. 1,500 rupees goes to a liquid FD or RD. This builds your 3-month emergency buffer, so you never have to sell your other investments during a crisis. 1,000 rupees goes into an ELSS SIP and 500 into PPF. This combination satisfies your tax-saving requirements while balancing market growth with government-backed safety. The remaining 2,000 rupees goes into a Nifty 50 index fund. This is the primary engine for your wealth over the next 20 years. This structure protects your current lifestyle from emergencies while ensuring your future self is funded by the growth of the Indian economy. A 500 rupee contribution might seem too small to impact your life, but the math of compounding suggests otherwise. If you invest 500 rupees a month at a 12% return, the growth is slow initially. However, by year 30, that small monthly habit results in a corpus of over 17 lakh rupees. Starting today with a small amount is more effective than waiting years to start with a large one. The time your money spends in the market is your greatest advantage. The instruments you choose matter, but the only strategy that is guaranteed to fail is the one you never put into action.